In 1971, President Richard Nixon made a phone call. That phone call changed money forever. He severed the last connection between dollars and gold. From that moment, money became something else entirely. Not backed by metal, not backed by anything physical, just numbers. Numbers that banks could create with a keystroke. Tonight, we're going to explore something that sounds impossible, something that challenges everything you thought you knew about money. Banks create money out of nothing, not metaphorically, not approximately, literally out of nothing. Take a deep breath. Let's begin.
Welcome to Late Economics, where economics becomes clear through the ideas and moments that shaped our world. Subscribe for more.
When you walk into a bank to borrow money, most people imagine the bank is lending you someone else's deposits. That money already exists, sitting in a vault somewhere, waiting to be loaned out. This feels logical, it feels safe, it feels real. But it's wrong. Here's what actually happens. You apply for a loan, the bank approves it, and then they type numbers into a computer. Those numbers become your loan. The money didn't exist before that moment. It was created by the act of lending. Think of it like this. You ask for $10,000. The bank doesn't go to a vault, doesn't call other customers. They simply add $10,000 to your account and simultaneously add $10,000 to their own records as a loan you owe. The money appears from nothing. This is called credit creation, and it's how most money enters the economy, not through government printing presses, not through gold mines, through banks typing numbers into computers. Let that sink in for a moment. The money in your account right now, most of it was created this way by banks making loans to people like you. Let's understand the mechanism more carefully. When a bank creates a loan, two things happen simultaneously. On one side of the bank's ledger, they record an asset, your promise to repay the loan. On the other side, they record a liability, the deposit in your account. This is called double entry bookkeeping. It's how banks keep their books balanced. Now here's the important part. That deposit in your account is real money. You can spend it, you can transfer it, you can withdraw it as cash. It's not fake, it's not an IOU, it's actual money. But it didn't exist before the loan. The loan created the deposit. This sounds like magic, but it's not. It's accounting with the power to expand the money supply. Think of it this way. If I lend you a car, I no longer have that car. But if a bank lends you money, they still have their money. And you now have money too. The total amount of money in the system just increased. This is why economists say banks don't lend deposits. They create deposits by making loans. It's backwards from what we imagine, but it's how the system actually works. Now you might ask, isn't this dangerous? Can banks just create infinite money? The answer is not quite. There are limits, regulations, requirements. But those limits are not what most people think. Banks aren't limited by how much cash they have. They're limited by capital requirements, by borrower credit worthiness, by their ability to manage risk. But the fundamental mechanism remains the same. Loans create deposits. Money comes from lending. Now let's see what happens across the entire system when one bank creates money through a loan. That money doesn't stay still. You borrowed $10,000 to buy a car. You transfer that money to the car dealer. The dealer deposits it in their bank. Now that bank has a new deposit, and they can use that deposit as the basis for new loans. They lend $9,000 to someone else. That person spends it on something else, and the cycle continues. This is called the money multiplier effect. One initial loan of $10,000 can eventually create $50,000 or more of total deposits across the banking system. This is how the money supply expands, not through government printing, not through central bank decisions alone, but through commercial banks making loans. In fact, most money is digital, created by banks through lending. Physical cash, coins, and paper bills, they represent only about 3% of the total money supply. The other 97% exists only as numbers in computer systems, numbers that were created by banks making loans. This is the bloodstream of the modern economy, money flowing from banks to borrowers to spenders to other banks, creating and destroying constantly. Because when you repay a loan, the opposite happens. The money disappears. Just as it was created by lending, it is destroyed by repayment. The money supply expands and contracts with every loan made and every loan repaid. This is the rhythm of modern money. This system didn't appear overnight. It evolved over centuries. Let's go back to medieval Europe. Goldsmiths held gold for wealthy merchants. They stored it safely in their vaults. And in return, they issued receipts, paper notes, that proved you owned gold. These receipts became convenient. Instead of carrying heavy gold, merchants used the receipts. They traded them like money. The goldsmith's receipt was as good as gold because you could always redeem it. But then, the goldsmiths noticed something. Not everyone redeemed their gold at the same time. Most of the gold just sat there in the vault, doing nothing. So the goldsmiths had an idea. What if they issued more receipts than they had gold? What if they lent out receipts for gold that didn't exist? As long as not everyone asked for their gold back at once, nobody would know. This was the birth of fractional reserve banking. The goldsmith holds only a fraction of the gold that the receipts claim to represent. The rest is lent out or doesn't exist at all. This practice spread. By the 1600s, banks across Europe were doing this. They held some gold, but lent out claims to much more gold. The system worked because of trust. As long as people believed they could get their gold back, they didn't need to actually get their gold back. The receipts were enough. Money had become a shared belief, not a physical thing, but a promise that enough people trusted to keep the system functioning.
This practice spread. But let's slow down and understand how this became the system we know today. In 1694, something extraordinary happened in London. England was at war with France. The government needed money desperately. But the king had a problem. Nobody trusted him to repay his debts. He had defaulted before, seized assets, broken promises. So, a Scottish merchant named William Paterson proposed an idea, a radical idea. What if a group of private individuals formed a bank, not the King's Bank, but a private institution that would lend money to the government? In exchange, this bank would receive special privileges: the right to issue banknotes, the right to create money. This was the birth of the Bank of England, the first modern central bank. Let's be clear about what happened. A group of wealthy merchants pooled their resources. They gathered £1,200,000 in gold and silver, and they lent it to the government. But here's where it gets interesting. The Bank of England didn't just lend that £1,200,000. They issued banknotes worth far more, notes that promised to pay the bearer in gold. But they didn't have enough gold to back all the notes. They were creating money the same way the goldsmiths did, through promises backed by only a fraction of actual metal. The government accepted these notes as payment, and soon everyone else did too. Why? Because the Bank of England had the King's blessing, had powerful backers, had the appearance of stability. People believed the notes were good, and belief made them good. This model, this partnership between government and private banks, spread across Europe. Each country developed its own version, but the principle remained the same. Private institutions creating money through lending, through fractional reserves, backed by government authority, protected by law. Now let's jump forward to a family that understood this system better than anyone: the Rothschilds. In the early 1800s, 5 brothers from Frankfurt spread across Europe's financial capitals: London, Paris, Vienna, Naples, Frankfurt. Each brother established a bank, and together they created the first international banking network. The Rothschilds understood something profound. Money didn't need to physically move across borders. They could settle accounts through ledgers, through promises, through coordination. If someone in London owed money in Paris, the Rothschild Bank in London would mark a debit. The Rothschild Bank in Paris would mark a credit. No gold needed to travel, just information. This was revolutionary. It made international trade faster, cheaper, more efficient. But it also revealed a deeper truth. Money was becoming abstract, less about physical metal, more about accounting, trust, networks. The Rothschilds financed governments, wars, infrastructure. They understood that lending to governments was the most profitable business in the world, because governments could tax their citizens to repay debts. They had the ultimate guarantee, the power to compel payment. This model of private banks lending to governments became the foundation of modern finance. But there was tension, always tension, between those who trusted this system and those who feared it. In America, this tension ran deep. The Founding Fathers debated fiercely about whether a central bank should exist. Thomas Jefferson warned against it. He believed that banking institutions were more dangerous than standing armies. Alexander Hamilton argued for it. He believed that a strong financial system was essential for a strong nation. America experimented with central banks twice. The first Bank of the United States in 1791, the second bank in 1816. Both were controversial. Both were eventually shut down. The debate was always the same. Should private banks have the power to create money, or should that power belong to government alone? Neither side won completely. Instead, a compromise emerged. By the early 1900s, America's banking system was chaotic. Thousands of banks issuing their own notes. No central coordination, frequent panics, frequent failures. In 1907, a severe banking crisis struck. J.P. Morgan, the famous banker, personally intervened, using his own money and influence to stabilize the system. But everyone knew this couldn't continue. The system needed reform. And so, in 1910, a secret meeting took place on Jekyll Island, off the coast of Georgia. The most powerful bankers in America gathered there, along with government officials. They met in secret, using fake names, because they knew the public wouldn't trust them. They were designing a new central bank, a bank that would be privately owned, but government-sanctioned, a bank that would control the money supply, prevent panics, stabilize the economy. In 1913, Congress passed the Federal Reserve Act, creating the Federal Reserve System. This was America's third attempt at a central bank, but this time it was structured differently. Not one bank, but 12 regional banks, overseen by a board in Washington. The Federal Reserve would become the most powerful financial institution in the world. But its creation was controversial then and remains controversial today. Critics argue it gave too much power to private banks. Supporters argue it stabilized the financial system. Both are right in different ways. What matters for our story tonight is understanding how this system evolved. From goldsmiths issuing receipts, to the Bank of England creating notes, to the Rothschilds building international networks, to the Federal Reserve controlling America's money. Each step moved further from physical money toward abstract money. Money as information, money as agreement, money created through lending. This is the system we inherited, a system built over centuries through experimentation, through crisis, through the recognition that money doesn't need to be physical. It just needs to be believed in. And the institutions that create it
need to be trusted, or at least accepted by enough people for the system to function. This history is not just academic. It explains why the system works the way it does today, why banks have the power to create money, why governments support this power, why trust is more important than gold. The system emerged not from a grand plan, but from centuries of trial and error, of crises and reforms, of power struggles between private wealth and public authority. What we have now is the result, neither perfect nor inevitable, but functional enough to persist. Let's continue our journey. Fast forward to today. The system has evolved, but the principle remains the same. Banks don't need your deposits to make loans. This surprises people, but it's true. Let's be clear about what actually limits banks. It's not deposits, it's capital requirements. Regulations that say banks must hold a certain amount of their own money relative to their loans. This protects the system from collapse. If too many loans go bad, the bank's capital absorbs the losses before depositors lose their money. But here's the key. Reserves follow loans, not the other way around. A bank makes a loan first, creates the deposit in your account, and then, if needed, borrows reserves from other banks or the central bank to meet regulatory requirements. This is backwards from the common understanding. People think banks collect deposits first, then lend them out. But that's not how it works. Banks create loans first. Deposits appear as a result. Reserves are arranged afterward to comply with regulations. Think of it like building a house. You don't need all the materials before you start building. You start building and acquire materials as you go. Banks start lending and find reserves as needed. The system is designed to be flexible, to expand and contract with demand. When businesses need credit to grow, banks can create it. When borrowers repay loans, the money disappears. The money supply breathes in and out with the rhythm of economic activity. This is modern banking, not a warehouse for deposits, but a factory for money creation. Now we arrive at a contradiction. Two things that both seem true, but can't be true at the same time. Ask most people how banks work. They'll say, banks accept deposits, then lend those deposits to borrowers. The bank is a middleman, connecting savers to borrowers. This makes perfect sense. It feels safe. It feels logical. But ask an economist or read banking regulations, and you'll hear something different. Banks create deposits by making loans. They don't lend existing money. They create new money through lending. Both explanations feel correct, but they describe completely opposite processes. So which is true? The economist's version is technically correct. Banks do create money through lending, but the public's version isn't entirely wrong either, because banks need depositors to have confidence. They need people to believe their money is safe. The system works because most people don't understand it. If everyone knew that banks create money from nothing, would they still trust the system? If everyone knew that only 3% of money is physical, would they panic and demand cash? The paradox is this: the system requires ignorance to function. It requires people
to believe a simplified story while operating according to different rules. This isn't a conspiracy. It's not a secret hidden from the public. The information is publicly available in economics textbooks, in banking regulations, but it contradicts common sense so strongly that most people don't believe it. Even when told directly, they assume there must be some catch, some simplification that makes it not quite true. But there's no catch. Banks really do create money out of nothing. The catch, if there is one, is that the money isn't backed by anything physical. It's backed by debt, by promises to repay, by the full faith and credit of borrowers, and by the system's ability to enforce those promises. Money is debt, and debt is money. This is the paradox at the heart of modern banking. Let's follow a single loan through the system. Meet Sarah. She wants to buy a small house. She goes to a bank and applies for a mortgage, $200,000. The bank reviews her application, her income, her credit, and approves the loan. Now watch what happens. The bank doesn't go to a vault, doesn't transfer money from other accounts. They simply type numbers into their system. Sarah's account now shows $200,000. Where did this money come from? It came from the act of lending itself. The bank created it by approving the loan. Sarah transfers the $200,000 to the seller. The seller receives the money in their account. They don't know this money was just created. To them, it's just money. The seller uses that money to pay off their own mortgage. The money travels to another bank. That bank receives a deposit, $200,000. Now they can make new loans based on this deposit. They lend $180,000 to a business. The business uses it to buy equipment. The equipment seller receives the money, deposits it in their bank, and the cycle continues. One original loan of $200,000 has now generated multiple deposits across different banks. The total money supply has grown, but here's what's beautiful and strange. That original $200,000 never really existed. It was created by the bank making the loan to Sarah, and yet it's real enough to buy a house, real enough to pay suppliers, real enough to keep the economy moving. Over 30 years, Sarah repays her mortgage. Every month, she sends money to the bank, and slowly that money disappears. It's destroyed by the repayment, just as it was created by the original loan. By the time Sarah owns her house, the $200,000 no longer exists. It came from nothing, did its work in the economy, and returned to nothing. This is the life cycle of money, created by lending, destroyed by repayment, temporary but real while it exists. We've seen how money is created through lending, through the banking system. Sarah's story showed us how it works when everything goes right. But what happens when it goes wrong? Let's look at 3 moments in history when the system nearly collapsed. First, let's go back to 1929. America was booming. The stock market was soaring. Banks were lending freely. Money was being created at an extraordinary rate. People borrowed to buy stocks. They borrowed to buy houses, to buy cars. The economy felt unstoppable, but underneath, cracks were forming. Many loans were made to people who couldn't repay. Stock prices were rising far beyond the actual value of companies. The boom was built on optimism and debt. In October 1929, the stock market crashed. Suddenly, people couldn't repay their loans. Banks had lent money that they created based on the assumption that borrowers would repay. But now, those loans were failing. One by one, banks began to fail. When a bank failed, the deposits disappeared. Remember, those deposits were money created by lending. When the loans went bad, the money vanished. People panicked. They rushed to banks, demanding their money in cash. But banks didn't have enough cash. Most of the money existed only as numbers in ledgers. This created a terrible cycle. People withdrew money, forcing banks to call in loans. Calling in loans destroyed money, crashed asset prices. Crashing prices made more loans go bad. More bad loans meant more bank failures. More bank failures caused more panic. By 1933, nearly half of America's banks had failed. 9,000 banks gone. Millions of people lost their savings. The money they thought they had simply disappeared. This was the Great Depression, the worst economic crisis in modern history. It taught us a brutal lesson. Money created by lending is fragile. It depends on confidence, on repayment, on stability. When confidence breaks, money vanishes as quickly as it appeared. The government responded with reforms. The FDIC to ensure deposits, regulations to limit bank risk. These reforms prevented total collapse, but they couldn't eliminate the fundamental fragility. Let's jump forward to 2008, a different era, a different crisis, but the same underlying dynamic. In the early 2000s, American banks discovered something. They could make enormous profits, lending money for home mortgages, and not just to credit-worthy borrowers. They could lend to anyone, people with bad credit, no income verification, nothing down. These were called subprime mortgages. The banks didn't care if borrowers couldn't repay because they sold the mortgages to other financial institutions who packaged them into complex securities and sold them to investors worldwide. The system was creating massive amounts of money through mortgage lending. Housing prices soared. Everyone believed prices would keep rising forever, but of course, they didn't. In 2007, housing prices began to fall. Suddenly, borrowers couldn't repay their mortgages. They couldn't refinance, couldn't sell their homes. Defaults began to spread. And because these mortgages had been packaged and sold, the losses spread throughout the entire financial system. Banks that held these securities faced enormous losses. They stopped trusting each other. They stopped lending to each other. The money creation process froze. In September 2008, Lehman Brothers, one of the largest investment banks, declared bankruptcy. The shock rippled across the world. Stock markets crashed, credit markets seized up. For a moment, it seemed the entire system might collapse, just like 1929. But this time, governments acted differently. Central banks created trillions of dollars out of nothing, just like commercial banks do. They injected this money into the financial system to prevent total collapse. The government bailed out major banks, not because they deserved it, but because letting them fail would destroy too much money too quickly. The system survived, but barely. Millions of people lost their homes, their jobs, their savings. The money that had been created through subprime lending was destroyed. When those loans failed, it came from nothing, did its damage, and returned to nothing. Now let's look
at a smaller crisis, but equally revealing. Cyprus, 2013, a small island nation in the Mediterranean. Its banking system had grown enormously. Banks there accepted deposits from around the world, particularly from Russia. They offered high interest rates, attracted massive deposits, and lent that money aggressively, much of it to Greece, which was in crisis. When Greek debt collapsed, Cypriot banks faced catastrophic losses. In March 2013, the government did something unprecedented. They imposed a bail-in, not a bailout where government pays, but a bail-in where depositors pay. People with more than 100,000 euros in banks would lose part of their deposits to recapitalize the failing banks. Think about what this means. The money in people's accounts was taken to save the banks. This violated a fundamental assumption that deposits are safe, are yours. But in Cyprus, the government decided that the banking system mattered more than individual deposits. People were shocked, horrified. Lines formed at ATMs, but it was too late. The banks were closed, accounts were frozen. When they reopened, the money was gone. This was different from 2008. In America, governments printed money to save banks. In Cyprus, they took depositors' money instead. Both solutions to the same problem. Banks had created too much money through lending. Too much of that money was based on bad loans. When the loans failed, someone had to bear the losses. In America, taxpayers bore the cost. In Cyprus, depositors did. These three crises teach us something profound. Money created through lending can disappear just as quickly. When confidence breaks, when loans fail, when panic spreads, the money supply can contract violently. This isn't a flaw in the system, it's built into the system. Money is created by lending. Money is destroyed by default. The balance between creation and destruction determines whether the economy expands or collapses. In 1929, destruction overwhelmed creation. In 2008, governments created massive new money to compensate. In Cyprus, they sacrificed depositors to maintain the system. Each crisis reveals the same truth. Modern money is not stable. It expands and contracts with the rhythm of lending and repayment. And when that rhythm breaks, the consequences can be catastrophic. But here's what's remarkable. Despite these crises, the system survives. It survives because governments intervene, because central banks can create unlimited money when necessary, because we've learned that letting the system collapse is worse than any intervention. The system is fragile, but protected, vulnerable, but resilient, not because it's well designed, but because we've decided collectively that maintaining it is essential, even when it fails spectacularly. We rebuild it, reform it, and continue, because the alternative, a world without this kind of money creation, would be worse, or at least
That's what we believe, and belief, as we've learned, is all that really matters. So where is the real money? If 97% of money is digital, created by banks through lending, where is the other 3%? That 3% is physical currency, coins and paper bills printed by governments, minted by central banks. This is the money you can touch, the money in your wallet. But even this physical money isn't backed by anything tangible anymore. Since 1971, when Nixon ended the gold standard, paper money is just paper, valuable because we agree it's valuable, because governments say it's legal tender, because trust holds the system together. Banks don't hold huge vaults of cash. They hold some cash for daily withdrawals, but most money never becomes physical. It moves electronically from account to account, numbers in databases, ledgers recording who owns what. Think about your last purchase. Did you use cash? Probably not. You used a card or your phone. Digital money moving instantly from your account to the merchant's account. No physical money changed hands, just numbers, decreasing in one database, increasing in another. This is how most money moves. Most money never exists in physical form. It's born digital, lives digital, dies digital, created by banks, destroyed by repayments, never touching the physical world. And yet, it's real enough to buy food, to pay rent, to build businesses. Money has become pure information, pure agreement, pure trust, backed by nothing except our collective belief that these numbers mean something, that they can be exchanged for real goods and real services, that the system will continue to function as long as we believe it will. This is the nature of modern money. Not a thing, but an idea we all share, and by sharing it, make it real. Now you might be thinking, if banks create money from nothing, if most money is just numbers, isn't this incredibly fragile? What happens if people lose trust? What happens if everyone wants their money at once? This is called a bank run, and it's exactly what banks fear most. In the 1930s, during the Great Depression, this happened across America. People panicked. They rushed to banks demanding their deposits in cash. But banks didn't have enough cash because most of the money existed only as loans. Banks failed, one after another, thousands of them. Life savings disappeared. This trauma led to major reforms. In 1933, the US created the FDIC, Federal Deposit Insurance Corporation. Now, your deposits are insured up to $250,000 per account. Even if the bank fails, you get your money back. This insurance creates confidence. People don't panic because they know they're protected. The system is more stable because of this trust. But the fundamental fragility remains. Banks still create money that doesn't physically exist. They still depend on confidence to function. The difference now is that confidence is backed by government, by central banks that can create money to save failing banks, by regulations that limit how much risk banks can take, by deposit insurance that protects ordinary people. The system works not because it's inherently stable, but because we've built safeguards
to prevent collapse, to maintain trust even when banks fail, and banks do fail. In 2008, Lehman Brothers collapsed. A global financial crisis followed, but the system didn't collapse entirely because central banks created trillions of new money to stabilize the system, to restore confidence. This is the bargain of modern banking. Banks create money to fund economic growth, but governments must stand ready to create money to save the system when it threatens to collapse. It's fragile, yes, but deliberately so. The fragility creates discipline. Banks that take too much risk can fail, but the system as a whole is protected by the government's ultimate power to create money without limit. This is how we've made peace with fragility, not by eliminating it, but by building a safety net beneath it.
So why do we have this system? Why allow banks to create money? Why not just have governments create all money? The answer is surprisingly simple. Economies need to expand. Businesses need credit to invest, to grow, to hire. Individuals need credit to buy homes, to get education, to start businesses. If money supply were fixed, if governments only created a limited amount, the economy would suffocate. There wouldn't be enough money to facilitate all the transactions, all the growth, all the investment that we need. Banks solve this problem by creating money when it's needed and destroying money when it's repaid. The money supply expands and contracts with the rhythm of economic activity. Think of it like breathing. The economy inhales when loans are made. Money enters the system. The economy exhales when loans are repaid. Money leaves the system. This breathing is automatic, responsive to demand. When businesses see opportunities, they borrow. Money is created to fund those opportunities. When times are uncertain, borrowing decreases, money supply contracts. This flexibility is the system's strength, but it's also a source of instability, because banks create money based on optimism, based on beliefs about the future. If everyone believes the economy will grow, banks lend freely, money expands. If everyone fears recession, banks restrict lending, money contracts. These cycles of expansion and contraction are built into the system. They're not bugs, they're features. The system is designed to amplify economic optimism and to amplify economic fear. This creates booms and busts, periods of rapid growth, followed by crashes. We've learned to moderate these cycles through regulation, through central bank intervention, through deposit insurance and emergency lending. But we haven't eliminated them, because the system fundamentally depends on banks creating money in response to demand. And demand is driven by psychology, by confidence and fear, by collective beliefs about the future. This is why banking crises keep happening. 2008, 1929, 1873, 1837. Different causes, different contexts, but the same underlying dynamic. Money is created based on optimism until that optimism proves unfounded. Then the system contracts violently, destroying money, destroying confidence, until eventually optimism returns and the cycle begins again. This is the price of a flexible money supply. Growth and opportunity come with instability. The system creates prosperity, but also fragility. We've chosen to live with this trade-off because the alternative, a fixed money supply, would limit growth even more severely. So we've seen why this system exists, why banks create money, why economies need elastic money supply. But let's pause and consider the alternative. What if money couldn't be created by lending? What if the money supply were fixed? This isn't theoretical. It's how money worked for most of human history. Under the gold standard, the amount of money in an economy was limited by the amount of gold available. Governments couldn't just create money. Banks couldn't create unlimited credit. Everything was constrained by physical metal. This sounds appealing at first. No inflation, no currency manipulation, no banks creating money from nothing, just solid, tangible value. But the gold standard had severe problems. When economies grew, they needed more money to facilitate trade, to enable transactions. But if gold supply didn't increase, there wasn't enough money to go around. This created deflation, prices falling, not because goods were cheaper, but because money was too scarce. Deflation sounds good, but it's devastating. Why buy today if prices will be lower tomorrow? Why invest if the money itself becomes more valuable just by holding it? Economic activity grinds to a halt. The gold standard also made international trade difficult. Countries with gold could import freely. Countries without gold couldn't. This created huge imbalances and tensions. Wars were fought partly over gold reserves. By the 20th century, the gold standard was crumbling. The Great Depression dealt it a fatal blow. Countries needed to create money to fight the crisis, but gold limited them. One by one, they abandoned the gold standard to save their economies. By 1971, when Nixon ended dollar convertibility, the gold standard was already dead. Nixon just made it official. Since then, we've lived in a world of pure fiat money, money backed by nothing except trust and the ability of banks to create it through lending. Now fast forward to 2009, in the wake of the 2008 crisis. Someone or some group calling themselves Satoshi Nakamoto published a paper describing a new kind of money, Bitcoin. Bitcoin was designed as a direct response to the financial crisis, a form of money that no bank could create, that no government could control. With a fixed supply, forever capped at 21 million coins, it was, in essence, a digital gold standard. Bitcoin's appeal comes from what it rejects. It rejects
rejects the power of banks to create money. It rejects the fragility of debt-based systems. It rejects government control over currency. To Bitcoin believers, our current system is broken, corrupt, unstable, unfair. Bitcoin
offers an alternative, money that can't be created by lending, money that can't be inflated away, money that exists outside the banking system. But here's the question we must consider. Could an economy actually run on Bitcoin or on any fixed supply money? The answer is complex. A fixed money supply means no monetary expansion. When the economy grows, there's not more money to facilitate it. This would cause severe deflation, making debt impossible to repay, making investment unattractive. Bitcoin works as a store of value, as digital gold. But as a currency for a growing economy, it faces the same problems that killed the gold standard. Not enough flexibility, not enough elasticity. The modern economy requires credit, requires the ability to create money to fund growth. Bitcoin, by design, cannot do this. This is the fundamental trade-off: stability versus flexibility, fixed supply versus elastic supply, protection from inflation versus enabling growth. There is no perfect solution. The gold standard was too rigid. It strangled economies, caused depressions. The current system is too flexible. It enables bubbles, enables crises, enables crashes. Bitcoin offers a return to rigidity, but that rigidity comes with the same old costs. So, we're left with an imperfect system, one that requires constant management, constant intervention, constant risk, but also one that allows economic growth, that allows credit, that allows opportunity. The alternative, a fixed money supply, offers stability, but at the cost of growth. And modern societies have decided that growth matters more than stability, that the risks of elastic money are worth bearing for the benefits it enables. This isn't a final answer. Perhaps someday we'll invent a better system, one that combines the stability of fixed supply with the flexibility of credit creation. But for now, we live with what we have, a system that creates money from nothing, that relies on trust, that survives through crises, that is fragile but functional, neither perfect nor inevitable, but the best we've managed so far. Let's pause and consider what this really means. Money is not what we think it is. It's not a thing, not a commodity, not a piece of metal, not even really paper. Money is an agreement, a shared hallucination that becomes real because enough people believe in it. Think about that for a moment. The money in your account doesn't physically exist. It's numbers in a database created by a bank making a loan to someone somewhere.
And yet, you trust it, you work for it, you save it, you spend it, you believe it has value. And because you believe, and because millions of others also believe, it does have value. This is the magic of money. Not that banks create it from nothing, but that we all agree to treat it as real. We could, if we wanted, reject the whole system, demand only gold or silver or some other physical commodity, but we don't, because the current system works well enough to keep us participating. It delivers goods, it facilitates trade, it enables growth and opportunity. As long as it continues to do these things, we continue to believe. The system persists, not through force, but through collective agreement. Billions of people acting as if these numbers, these promises, these digital entries are valuable, and by acting as if, they become valuable. This is perhaps the most sophisticated social technology humans have ever created. Not buildings, not machines, not computers, but money, a system of pure information, pure agreement that coordinates the activity of billions without central planning, without complete transparency, through trust distributed across the system. Each person trusts their bank, each bank trusts other banks, each government backs this trust with laws and force, and somehow it all works most of the time. Not perfectly, not without crises, but well enough to create the modern world. Cities that never sleep, supply chains crossing oceans, technologies that would seem like magic to our ancestors. All of it funded by money that doesn't physically exist, created by banks out of nothing, destroyed by repayment, back to nothing, temporary, yet real, imaginary, yet powerful. This is the strange truth of modern money. It's whatever we agree it is, no more, no less. And that agreement, that shared belief, is stronger than gold, stronger than government decree, because it's chosen freely by billions of people every day when they accept payment in numbers, when they trust that those numbers can be exchanged for real things, for food, for shelter, for the stuff of life. Money is belief made solid by consensus. So let's remember what we've learned tonight. Banks create money out of nothing, not by printing, not by mining, but by making loans. The loan creates the deposit, not the other way around. Most money, 97%, exists only digitally, as numbers, in databases, created by lending, destroyed by repayment. Physical cash is just a tiny fraction. The system works because of trust. Trust that numbers can be exchanged for real things. This trust is protected by deposit insurance, by regulations, by central banks ready to intervene. The system is fragile, but deliberately so. Fragility creates discipline, while government backing prevents total collapse. Money expands when the economy grows, contracts when loans are repaid. This flexibility enables growth, but also creates booms and busts. Cycles we've learned to moderate, but not eliminate. The system evolved over centuries, from goldsmiths holding gold, issuing receipts for more gold than they held, to modern banks creating money through lending. The principle is the same. Fractional reserves, credit creation. Money is promise rather than substance. And this system persists because it works well enough to keep us believing that numbers have value, believing that promises will be kept, believing that tomorrow will resemble today. Money is agreement, social technology, consensus made solid, and that consensus creates the world we live in. A world where money flows like water, created upstream by banks, flowing through the economy and disappearing downstream through repayment, always moving, always temporary, yet always somehow there when we need it. This is money. This is banking. This is the system that creates everything from nothing and returns it to nothing again and again, in cycles as old as banking itself, as new as tomorrow's loan. So let's settle one more time into everything we've learned tonight. Banks create money out of nothing. This is not a metaphor. This is not an exaggeration. It's literally true. When you borrow from a bank, they type numbers into a computer, and those numbers become money. Money that didn't exist before. Money created by the act of lending. This money is real. You can spend it. You can save it. You can use it to build, to buy, to live. Most money in the world, 97%, exists only as numbers in computer systems created by banks making loans. Only 3% is physical, coins and bills you can touch. The rest is digital, abstract, but real. Real because we believe in it. Real because we agree it has value. This system evolved over centuries from goldsmiths holding gold, issuing more receipts than gold they held, to the Bank of England creating money for governments, to modern banks creating trillions through lending. The system works because of trust that numbers can be exchanged for real things, trust that promises will be kept, trust that tomorrow will resemble today. But trust is fragile. In 1929, it broke. Banks failed. Money disappeared. Depression followed. In 2008, it nearly broke again. Governments created trillions of new money to prevent total collapse. The system survived, barely, because we chose to save it. Money is created by lending. Money is destroyed by repayment. This is the rhythm of the system. breathing in, breathing out, expanding, contracting, always moving, always temporary, yet somehow always there when we need it. The alternative, a fixed money supply like gold, like Bitcoin, offers stability but prevents growth, prevents the flexibility economies need. So we live with this system, imperfect but functional, creating money from nothing and making it real through collective belief. Money is agreement. Money is trust. Money is numbers that become real because enough people act as if they are real. And by acting as if, they become real. This is money. This is banking. This is the system that creates everything from nothing and returns it to nothing in cycles. As old as modern banking, as new as tomorrow's loan. The money flows like water, created upstream by banks making loans, flowing through the economy, enabling trade, enabling growth, enabling life, and disappearing downstream through repayment. Always moving, always temporary, yet always somehow there. This is the nature of modern money, not a thing you can hold, but an idea you can share, an agreement among billions that these numbers, these promises, these digital
entries have value, and by agreeing, they do. Rest now. Let this understanding settle, like sediment in still water. The system continues while you sleep, creating money, destroying money, breathing in and out. The eternal rhythm of modern finance. Numbers appearing from nothing. Numbers disappearing to nothing, yet doing real work in between. Building cities, funding dreams, enabling the world we live in. This is money, created from nothing, but real while it lasts. Real because we believe, and belief is enough. Belief is everything. Rest now. The money keeps flowing. The system keeps working. And tomorrow it begins again.